All right, why don't we go ahead and get started? So thank you guys for joining today. We're going to talk about how to find the right share for you, which hopefully should be interesting. First, we got a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you are in New Zealand, you can get a copy of our FAP from our website, morningstar.com.au. And the New Zealand regulatory authorities encourage you to go seek out a financial advisor if you want personal advice. So a couple of things. We have taken a little bit of a break. I was on leave. I'm now home because everyone's getting this cool thing called COVID. So I thought I would join them, and they discourage you to leave their house. But I'll be back in the office next week to do these things. We have a new set of webinars starting on Thursday. So we'll send out an email Thursday morning that will allow you to register for all of those. So a bunch of different, hopefully interesting topics. So look out for that email on Thursday. If you want the registration link, you can send me an email also at mark.lamonica1@morningstar.com. And I do have a couple emails, so anyone who has written me that I need to get back to that came when I was on leave, but I will start going through those tonight. So, all right, let's get started. All right, how to find a share that's right for you. So why are we talking about this? Well, for those of you that attended earlier sessions, we did talk about how to find shares, how to find ETFs, how to find funds, but we also talked a lot about gold. The whole point, of course, in investing is to achieve your goal, and that means that we're all going to take different paths. So one of the problems in the industry in general, I think, is you hear a lot about stocks to buy, ETFs to buy, funds to buy. And of course, a lot of that has nothing to do with you. One way, obviously, to solve that is through personal advice, going to a financial advisor. That is very expensive right now. There are a lot of issues right now with financial advice in Australia, particularly the cost and just the lack of availability around advisors. So what we're going to talk about today is how you can do that on your own. So obviously nobody's looking out for your interests more than you are. So we're going to talk about how do you find something that's appropriate for what you're trying to achieve. And a couple reasons, as we said on here, why this is important is there are a lot of different ways to successfully invest. And I think a lot of people don't acknowledge that. So people talk about what has worked for them. That's based on their own particular circumstances. In many ways, that's based on historic market conditions that may not happen in the future. But what's really important is that you find something that you are comfortable with and an approach that resonates with you. And the reason you want to do that is because you'll stick with it. We know there are certain things that are very important to be a successful investor, and one of them is sticking with it. People who are constantly changing things in their portfolio, who are constantly changing strategies, that is almost a guarantee that you will not be successful. So the way that you stick with something is if you're comfortable with it. Doesn't mean it's necessarily something that works for your mates, works for your family, but if you're comfortable with it, you will more likely than not stick to it. Obviously, we all have different goals, and we also are different time frames of when we want to achieve those goals. So over the course of a lifetime, if you're saving for retirement, for example, what works in your 20s is not necessarily what you want to do when you are in your early 60s and approaching retirement. So we do need to acknowledge that. And then finally, we do need to think about what investing actively actually means. So if we are either investing in individual shares or if we are taking an active approach with ETFs, so that can be either through asset allocation decisions we make or just going out there and picking things like thematic ETFs, we need to acknowledge that in order for that to be successful, we need to have an edge or a competitive advantage over the average investor in the market. If you don't have or don't think you have a competitive advantage over the average investor in the market, then you can be the average investor in the market and simply invest passively. So that's also another important consideration. All right, so let's look at a lifetime. So we came up with this little scenario. Starting at 22 years old, you are saving $10,000 a year for your retirement. and you are going to earn a 7% return, and you end up with close to $2.5 million. So obviously, number one, this demonstrates why you should start early. But let's look at the life cycle over your lifetime of investing. And so what we've done is we basically started, and obviously it's only 8 years initially, but we've looked at every decade where you are. And there's a couple of things that should jump out at you when we look at this chart. So the first thing is, one of the problems with investing and one of the problems with compounding is that people talk about how great it is, but you also need to understand what that means. Most of your return, and we'll show how this demonstrates it here, most of your return is actually going to occur in the latter years of your life. So I think a lot of people get discouraged and they give up too easily. So let's look at that. So what we can see is the balance at each one of these points in time. And we can look at, once again, saving $10,000 a year, how much of your portfolio you are contributing. So, right, you're contributing $10,000 a year with a portfolio just over $100,000. That's 9.74%, right? So you're still putting in, at this point, at 38 years after starting to invest, you're still putting in a fair amount of your portfolio with just those contributions. And that has a lot of benefits. Has a lot of benefits around your ability to adjust your asset allocation without selling anything. And it also shows that the most important thing is keeping up with your savings there. Then we look at the impact of a 7% return, right? So initially, of course, the impact of market returns is below the impact of your savings. And we'll talk about the implications of that. Then finally, we looked at the percentage of time versus the percentage of the total value. So we're looking at time until retirement. So that's 22 over 43 years. So what percentage of that have we gone through? And then we're looking at the percentage of this close to $2.5 million number we have here. And that has a lot of implications. So let's walk through a couple of these. So time, obviously early on, you have lots of time, but time slowly runs out. So you have less time to save, and you of course have less time to compound that money you have. Human capital. So human capital simply refers to the fact that your education, your natural intelligence, the skills that you picked up, there is a price that the marketplace will pay for those. Obviously, over time, even if you're picking up more experience and more skills over that time, you are going to earn less money for the rest of your career because there's simply less years to return. And what you want to do is you want to convert that human capital by working and saving into financial capital. It does the opposite. So when you were young, you have less financial capital, but you need to make sure that when you're older, as you run out of human capital, that you have more financial capital. That's, of course, how you pay for retirement. You're no longer working, you're relying on what you save. So what are the implications? So the implications, of course, are when you are younger, you need to focus on earning money, and you need to really focus on that savings rate. And what you don't really care about is volatility, right? So we look here, we see the impact of 7% return. So yeah, $7,000, but you're saving $10,000 a year. So the most important number you need to worry about is not that return, is how much you're actually saving and getting into the market when you're younger. The exact opposite happens when you're older. As you're approaching retirement, you obviously have less time. You are saving a very small percentage, right? So about 0.5% of the money you actually have in your portfolio, you're saving every year. And the impact of the return is huge. And so what are we worried about then? Of course, we're worried about volatility. The other important thing to look at is these two numbers. So the percent of time you've gone through and the percent of total value. So why is this important? Well, it's important because people give up. So sitting there and saying that you have a $2.5 million goal seems very, very difficult to actually achieve when you're younger, right? So you sat there, you saved for 8 years, you saved and invested, and you have $102,000, and you think that is a very long way from 2.5 million, and that is true. But realize that what compounding means is that even at 60, so with 5 years left to retirement, you have gone through almost 89%, so over 88% of the time until retirement, but you still are only at 70% of your goal. What does that mean? It means those compounded returns that you earn at the end of your investing career, at the end of your working career here, are going to have a disproportionately large influence on how much money you run out. That is why you're worried about volatility. Because losses, obviously, at the end, and this is what we talk about all the time, the sequencing risk, losses at the end, as you approach retirement, the end of your retirement savings, can have a really big impact. So I think this is an interesting chart, but once again, I made it, so not really sure what that says. But anyway, all right, let's talk about how you find an investment that's right for you. And we talked a little bit about edge. So edge is just this ridiculous jargon that's used in the financial services industry to talk about competitive advantage. What is your competitive advantage over other investors? Now, remember, the average return that people get is represented by an index. That is, by definition, the average return. So some investors will beat that index. Some investors will do worse than that index. But if you don't think that there is a reason that you can do better than average, then it may make sense to go back and simply invest passively. So let's talk about the four sources of edge. And there are really only four sources of edge. So we'll go through an edge once again, ways and areas that you can have a competitive advantage. So think about which one of these apply to you. If you are investing actively, think about where your edge is, because if you can't come up with a reason why you have edge, then maybe it's not something that you should be doing. So we'll start with informational. So informational edge just refers to the fact that you have information that other investors don't. Now, this is very rare, and it's gotten more and more rare as time has gone on. So informational edge, now that we have the internet, right? Things are distributed globally in an instant. This does not happen very much. So when we talk about informational edge, a lot of it right now, and there are some exceptions to the rule, is actually illegal, right? So having information, companies are not allowed to give information to certain people. They have to disclose it to everyone. So whether you're a professional investor or whether you are just an individual investor, information needs to be disseminated to everyone. So a lot of this is insider trading, right, at this point. Now, that wasn't always the case. Right? Before we could distribute information instantly, maybe if you worked down in Wall Street and you knew somebody, you would have information before other people did. That's not true anymore. And there's been a lot of laws that have come out to make sure that informational edge is not something that really exists. Analytical edge. So analytical edge simply refers to the fact that we all have the same information, but there are people who can analyze it better. So they're taking the same information and they are drawing different and better conclusions than other people are. So analytical edge, if you think about it, that is what our analysts are trying to do. They are taking publicly available information and they are trying to come up with insights that other people don't have. So that's analytical edge. Behavioral edge, and I will say behavioral, when I think about myself, sort of behavioral and structural are the two places where I think, excuse me, I think I have an opportunity to actually have an edge. So behavioral basically means that you are making better decisions than other people. Now, generally what that means in terms of better decisions is you are not letting fear and greed influence what you are doing. This is the whole reason why we encourage you to set up a plan and have structure around what you're trying to achieve and how you're trying to achieve it. So that can stop you from making poor decisions in the face of volatility. So behavioral edge is something that all individuals, and it's not easy, it's easy, everyone could do it, but behavioral edge is something where all individuals do have the ability to have edge over other investors. So that's establishing a plan, establishing a rational reason why you are doing certain things, and then resisting all the temptations to change your plan. And those temptations can be your neighbor sitting there and talking about how much money they made off of some speculative investment. And it can be the fear that naturally happens when markets fall and everyone tells you you're going to lose all your money. So resisting those temptations is behavioral edge. And then finally, we have structural edge. Now, structural edge is a huge advantage that individual investors have. And what this really means is that professional investors have a lot of structural impediments to making good long-term decisions. And that doesn't on the surface seem to make much sense, but think about it. If you are doing something as a job, you have all sorts of other influences that are impacting your behavior. So one, you are not going to want to do what other people, something different than other people. Why? Because at the end of the day, professionally, it is better to fail along with everyone else than fail individually if you were doing something that other people aren't doing. So you tend to get this herd mentality, tend to get everyone investing in the same shares, doing the same things because they're trying to protect their jobs. And that makes perfect sense, right? They are, number one, generally high-paying jobs if you are managing money. And people have all the same considerations that all of us have with jobs. Families to support, families to support at the end of the day, mortgages to pay. And so you do see a lot of hurting with professional managers that do not want to actually take risks, even if you're paying them a lot of money to take those risks. The other thing around structural edge is, of course, you can't do whatever you want as a professional investor. So if you are a managed fund investor, you are basically governed by flows that come in and out of your fund. So even if you think there are a bunch of great opportunities when the market is really low, if everybody is withdrawing money from your fund, guess what? You need to sell things in order to fund those withdrawals. Same thing on the upside. You could say, wow, there really aren't any opportunities. The market's really overpriced. But if a bunch of new money is coming into your fund, well, guess what? You need to buy things. So you may not even be doing things that you necessarily want to do. You are being influenced by the behavioral issues of all the investors in your product. So there's lots of structural disadvantages. And what you tend to see out of professional money managers is they all say they're long-term. The vast majority of them are not. If you go and look at the turnover in actively managed funds and ETFs, it is pretty short. They are not long-term. So that's one thing that is an easy thing to do as an individual investor, is to invest long-term. The other thing is, of course, they have no idea what you're trying to accomplish. So they are trying to, of course, manage a pot of money within a specific mandate, but they don't know what your individual goals are. So that's another advantage you have. So think about these four sources of edge, and your source of edge can be different with different parts of your portfolio. And that's why it makes a lot of sense sometimes to have certain parts of your portfolio where maybe you want to take a more active strategy. You want to pick individual shares. You want to have some nuance to, or some different asset allocation approaches you want to take. Maybe invest in actively managed funds. And then there are parts of your portfolio where maybe you don't want to do that because you don't have any edge. So just think about the different places in your portfolio that you may have an edge. All right. Next thing we want to talk about is factors. So we're going to look at factors because different investments are different. Not all shares are exactly the same. And this is what we were talking about earlier. Trying to find things that, number one, resonate with you as an investor, but also match up with your goals. So that's what we're going to talk about now. So let's talk about financial strength. So we're going to talk a little bit about quality factors. Now, quality, of course, is just referring to companies that are higher quality versus lower quality. Now, on the surface, everybody, of course, would sit there and say, why would I ever invest in a low quality company? Well, there may be reasons. And the reason basically is that potentially there could be a lot higher returns, and you get those a lot higher returns because there's a lot greater risk, right? If you can find a company that is not doing well financially and they manage to turn it around, you could get outsized returns on that. But what are you doing to get those outside returns? You are going to face more volatility. And you can also face, of course, the loss of your investment because the company could go out of business. So this is something you need to think about. Think about what your goals are, what you're comfortable with. So in my case, I am very uncomfortable with low quality companies, so I just don't do it. So that means that yes, there are certainly cases where I am giving up a lot of returns, but I need to invest in the way that's comfortable for me. That's for me, not necessarily for everyone. So what are we talking about with financial strength? Well, basically what we're saying, just like you with your own finances, is companies that have a lot of debt, companies that are not in good financial shape, of course, are more risky. And the example that I always use, because I think it does resonate with people, is what happened with the airlines in Australia when COVID-19 hit. So obviously travel was horribly disrupted. And if we look at the two major airlines, one of them went out of business. So Virgin Australia went out of business, and Qantas, of course, stayed in business. Now, why? They both faced the same issues. Well, Virgin Australia was in heavy, heavy debt, and they had the misfortune, and Qantas has been in debt in the past as well, a lot of debt, but they had the misfortune to be in a lot of debt when something unthinkable happened that shut down, and nobody could have imagined this, shut down all air travel. But this is why we want companies, why we may want companies with strong financial strength, because of course the future is risky, it's unknowable. Financial strength means that you are able to weather those poor economic conditions and weather mistakes that you make, right, at the end of the day. So, having an emergency fund as an investor is a really important thing, right? It's really important because we don't know what's going to happen, and because you could make a mistake that could result in the loss of your job, for example. Having an emergency fund is a buffer. So that's financial strength. And I have a couple, and I'll send out the deck. But yeah, just a couple different items you can look at. So credit rating, of course, there are companies out there that are paid to assess the credit rating of a company and assign a credit rating to a company, looking at their ability to pay back their debt. So that, of course, can be an indicator of financial strength. Debt to equity. So if we actually do go and look at the balance sheet and we look at how much debt they have versus equity, that's a good indicator. Now, just remember that different industries have very different debt loads that they can handle. So when you're comparing a debt to equity, there is no good or bad at the end of the day, but compare a company to its sector or industry. And we want to do that because, of course, companies like an infrastructure company that has very steady, predictable cash flows, of course, can take on more debt. And they do take on more debt versus more volatile companies. So remember, make sure you're comparing debt to equity to the right thing. Interest coverage ratio, there's all sorts of coverage ratios. That's basically just looking at how much a company is actually earning versus what they have to pay. Of course, if you have a very low interest coverage ratio, it means a very small change in your revenue and earnings can result in you not being able to pay back your debt. And that, of course, leads to bankruptcy. And then finally, the maturity schedule of debt. So you have to pay interest on debt that you take out, but also you have to pay back the principal at some point. So what you want to see out of maturity schedule, so that's, of course, when they have to pay back the principal, what you want is to see it spread out. So it is a problem and it is a risk if all your debt as a company is due during a certain year. Because number one, you could not be doing well and not be able to pay it back. Number two, something externally could happen. There could be a big recession. There could be a global pandemic. I mean, all sorts of things that impact your ability to pay back your debt at that certain point in time or roll over your debt. And that's what people are so worried about. That's what central banks were so worried about with COVID, is that, one of the reasons that central banks in some cases started actually buying corporate debt is because they were very afraid that all these companies, and what Peter Warren likes to call zombie companies that are just rolling over their debt and aren't really making that much money, they're afraid all these companies were going to go out of business because there wouldn't be anybody that would actually buy their debt to allow them to roll that over. So that's what we saw around COVID. And, many argue that we're seeing the impact of that now, all that liquidity that was put in. That's financial strength. It's operating performance. Of course, another quality factor here, but what we're looking for, and we talk about this all the time with moats, is that what are you trying to do as a company? You're trying to use your existing resources. so the existing assets that you have, and you're trying to grow sales and earnings. So, and what are we trying to earn? What return are we trying to earn on that? We're trying to earn a return that is higher than the return for us to go out and get capital. So that is a sustainable competitive advantage. That is a moat. So a couple different things. We really like return on invested capital at Morningstar, but return on equity as well. So these are both items that look at what is the return on the assets that companies have. So both something that are very important to look at, particularly when we're comparing them to a weighted average cost of capital. Now, it's not the easiest thing to calculate on your own, but we all kind of know where interest rates are, right? And we can all sort of sit there and say, okay, what is a good return on invested capital, for example? So anything north of 10% is pretty good at the end of the day, because most companies are able to raise capital at lower than 10%. So something to think about there. Margin. So another huge indicator of a company that is doing a great job on earning investments on that they're making in the company is, a good way to earn a great return on those is to keep more of every dollar that you get. So all these different margins, and you can read the definitions, but they're all really looking at, okay, you have $1 of sales. How much of that do you get to keep? Because as a shareholder, of course, what the company keeps is yours. That's what you're keeping. And they can do whatever they want with what they keep. You can reinvest it back in the company. You can give it to shareholders in dividends or buybacks. You can pay down debt, all sorts of different things. So operating performance is a key measure of quality in a company. Sectors. So people don't think about sectors very much. And one of the big things we look at as investors is volatility. So volatility, of course, is how much the price of investment is bouncing around. And volatility is really important because if you start thinking about your goals and achieving your goals, as we did back on that first slide with the chart, we need to think about volatility because there are times in your life where you do not want volatility, particularly as you're approaching retirement. The other thing about volatility is, of course, volatility adds to behavioral risk. The more an investment bounces around, the more likely it is that you are going to do something stupid, because either you are going to get greedy, the investment has gone up a lot, and you're going to want to put in a bunch of money at what may be the top of the market, or of course you freak out when the investment goes down a lot, and of course you sell when you shouldn't sell. So volatility, number one, over the lifetime of the goal. Volatility could be something you really care about at certain times. And also, of course, it induces you to do bad things sometimes. Like different sectors have different levels of volatility. So when we look at sectors, what Morningstar has done is divided those sectors into what we call super sectors. 3 different categories: cyclical, defensive, and sensitive. So what we're talking about here is, of course, the economic cycle and how the economic cycle is going to influence those companies. So let's use a couple examples. Cyclical means that they are highly sensitive to the business cycle. So if the economy is doing very well, typically these companies perform very well. If the economy is doing really poorly, typically these companies perform really poorly. So an example we have, in a very good example for Australia, is Basic Materials. So Basic Materials are companies that produce something that generally a commodity that goes into construction at the end of the day. So if you think about iron ore, for example, obviously a great example here in Australia, iron ore is used to make steel. What do we do with steel? Well, we build buildings with it. When infrastructure is built, steel is involved. So when there's lots of investments in new construction, generally that will drive up demand. That'll be good for ore. When does that happen? Well, a lot of time it happens when the economy is doing very well. That's when businesses want to invest. Now, there are some exceptions to this, right? The governments invest in a lot of infrastructure when the economy is not doing well, but still, generally, these companies are very, very much tied to the business cycle. Defensive. So defensive means the company's kind of going to do the same, whether the economy is doing really well or really poorly. So very simply, we can think about wants. These are wants. These are needs. So consumer defensive, no matter how the economy is doing, you're probably going to go to Woolies and keep buying food because food's important. You're probably going to go and get medicine that's going to maybe save your life or improve the quality of your life. You're going to pay for your electricity. These are things that aren't going to bounce around as much because as the economic cycles change and as the market speculates, whether they change or not, as the market speculates about where we are in an economic cycle, you'll see more volatility in cyclical sectors than defensive sectors generally. So if you're someone trying to limit volatility in your portfolio, excuse me, I keep coughing, you might want to look at defensive stocks. All right, market capitalization. Sorry about that. How big is a company? So bigger companies generally are less volatile and less risky. Why is that? Because bigger companies have all of the things that would protect them from issues arising. So number one, they generally have better financial strength. So they have the ability, number one, they have better balance sheets. They have the ability to go access more capital if something bad happens. They generally have a larger, more diverse product line. So large companies generally don't just sell one thing. They sell multiple things. So something to think about. They also generally have a wider geographic presence. So they're selling goods in more countries, more different cities if they're just local to Australia. All of those things protect them from issues from that occur in a specific country, issues that could potentially occur in a specific state, depending upon what we're talking about. But large companies generally are safer. Now, what is safer? Is that a good or bad thing? Well, it depends what you're trying to achieve. Small companies, you see more volatility, but also there's potentially more upside. You see small companies generally do well when economies are accelerating out of a recession than large cap companies. But think about, once again, what you're trying to achieve. Are you trying to limit volatility, limit the amount of risk you're taking on? Then maybe larger companies, large cap companies are where you want to invest. Are you trying to make huge returns, even though you're taking on more risk? Then perhaps small companies are where you want to invest. Momentum. So momentum is an interesting one. So basically from the GFC, first of all, momentum is just measurements of how fast or how much a security price is accelerating at the end of the day and different price changes. So basically what momentum means is if you're a momentum investor, you are chasing performance. You are saying something that's done well recently will continue to do well. Now, this has worked very, very well since the GFC. So we have seen people that are investing using momentum as a factor do very well. Now, one of the issues, of course, is what has happened recently. And specifically, April is a good example of this. Momentum's not working too well anymore. So what we've seen is a lot of the former high flyers, a lot of particularly technology companies that had done well for years are not doing so hot right now. Now we're sort of going back and we're looking more at fundamentals, right? So the companies that have done so poorly, and if we look at NASDAQ was down 12%, something in April, which has been a continuing trend, that particularly companies that are more risky, lower quality, who were doing really well, are not doing well right now. So we're sort of seeing a reverse of momentum in a lot of different ways. But it is certainly a factor that many people are interested in. So we've actually made it at 1:35, which is good because I'm coughing a lot. We did have a couple comments, and they're both from Phil. Okay, so Phil says, he liked our recent podcast. So what do you think about that, Shawnee? He found it very interesting and very applicable here. Yeah, I thought it was decent too, obviously, because we put it together. But yeah, we did have a podcast we released on Sunday looking at investor behavior. So thank you for saying that, Phil. And Shawnee saying thanks, Phil. So Phil says, in my case, behavioral risk is hard to deal with. Sitting on the sidelines watching an expensive market, waiting for the dip to buy versus FOMO. Yeah, listen, I think it's really difficult to deal with. So, for a while, I've been sitting around talking about how the market's overvalued, and it's kept going up and kept going up and kept going up. So it is a really difficult thing to deal with. And this is really where it's important to kind of stick to your guns, because a lot of people do this. And if you look at like almost every market peak, what happens at the end? You get a bunch of new investors and a bunch of people buying at the market peak. And obviously not a great thing, but it happens literally every single time. And you see people, and Phil, I think, what you're saying, you see people cave, right? At the end of the day, they sit there and they've been saying, I'm sorry to use this as an example, Will, they've been saying that not going to buy Bitcoin, not going to buy Bitcoin, not going to buy Bitcoin. And eventually when Bitcoin's $65,000, they think, forget it. I need to get in. I'm tired of listening to all these people that have made all this money. I'll just do it. In many cases, that sort of represents a market peak, but it's very difficult for us to resist that. It's very difficult. We only hear good stories, right? It's very difficult to resist all these stories you're hearing about all these people making a ton of money doing a certain thing. So hopefully you can stick with it, Phil. But that's why we like writing stuff down, because that can be a thing that can help out with FOMO. All right, so I've hacked my way through 40 minutes almost. If anyone has any questions, just email me, mark.lamonica1@morningstar.com, and I will get back to you. So thank you, guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.